Hey guys, welcome to the show. It's Ascentis TV and it's June's edition. We've got another great lineup for you. In Tech Talk this time, Lee Koznowski is meeting Satago. In Financial Mastery, it's Back to Basics, my series on how to understand financial reporting. And I'm looking at the cash flow part 2 this time. Mark Overend is going to be doing tax tips and he's going to do his quick tip as well. And Lee will round the whole thing off with admin min, just making sure you guys comply with HMRC and Companies House regulations. So let's have a look at this video that Lee shot earlier this week for Tech Talk with Ashley from Satago, and it's all about avoiding bad debts.
Okay. Hi everyone. In this episode of Tech Talk, I want to move away a little bit from analysing your financial data and start looking at those insights into your customer base, because it's just as important. And for that, we've been joined by Ashley Barker of Satago. So, hi Ashley.
Hi Lee, thanks for having me.
You're welcome. Nice to see you. And do you want to just start by giving us a quick brief into how Satago came about, when it was formed, etc.?
Yeah, so Satago was created back in 2013 as an alternative finance solution for people that didn't want to do long-term or vast amounts of finance, but they needed an immediate cash to cover gaps turning up or unexpected bills that needed to be paid. But it's now changed. It's now turned into a one-stop cash management solution, covering everything from credit control, alternative finance, credit searching, and risk insights as well.
Perfect. And it's those risk insights that I really want to concentrate on in this meeting, because some of the stats we're seeing at the moment in terms of bad debts, 1 in 5 have written off a bad debt worth £35,000. And, we can only imagine that this is going to get worse with the current pandemic crisis we've got. So how is Satago actually helping or helping customers analyze their customer database? Well,
fundamentally, it's depending on the person who's running the business, or a finance controller or credit controller or simply a business owner. The idea is it's as soon as they plugged it in, they pulled the data through from zero, they can see what debts they should be looking at, what debts are at risk of not being paid based on their debtors' credit report information. Now, that's one way of looking at it, but instead of being in the platform 24/7, you get notifications when it changes. So if one of your own debtors is struggling, you can then receive the notification that their credit report has changed. You can go and have a look, see what's going on, and then maybe adjust the payment terms you have with that client or concentrate on the debt they owe you, just to make sure that that gets paid to you as well.
Sounds great. I mean, are we able to just jump into a bit of a demonstration so we can visualize it?
Yeah, of course. Let me just hopefully get some wizardry going and share a screen. So there you can see our risk analysis tab. Now, again, this information is automatically populated simply by connecting through to the Xero software. And again, probably some stuff that you'll be very familiar with. You've got the age debtor report. You can see what's outstanding, how much is outstanding, and what's overdue. And then the risk segment side would be new to yourself. It's a sense of understanding of those debts, how much is at risk of not being paid. Now, I'm lucky enough, I've got this in yellow and green. So if I hover over very low risk, I've got £968,000 there. Fundamentally, it's making my 90+ day stuff look good. But what I really want to know is, well, out of those 90+ days and out of my very high risk debt, what is the stuff I need to concentrate on? So I've taken a £1.3 million debt that's overdue down to 397,000 because it is my riskiest debt. Now, obviously, you'd start concentrating on the very high risk at 90+ days and make sure that comes in. But then you eventually,
you don't want, really, aren't there?
No, that's very true. I mean, if it's people get worried, it's where everybody's eyes go to first because they want to see what falls into this section. Simply being, it could be a company that's going into liquidation or is running down, and you want your debt to be paid, so you want to make sure you're on top of these. Now, if you can get to a stage where all your debt's falling into this top left-hand corner, you're in the best business position that you could be in. But again, with this screen, it's simply understanding what's going on with your debtors as well. So again, what's your biggest overdue debt? Most people will take a hazarded guess at what that is. From here, we simply clicked into it. We can see what that £14,000 is, who it's for, what the invoice number is, and how long it's overdue. And fundamentally, what's the biggest overdue invoice? What's something that I've maybe missed and need to go back and look at? So again, simple information at a glance. And understanding clients as well. It's always interesting to see what's going on with your clients and having information that could preempt potential problems that are going to occur. So the customer credit summary will simply do that for you. I will quickly click into this one, because the idea here is you can see a list of your clients, you can see what their credit score is, you can get notified on any changes that are happening. So you see I've got 2 clients that are getting a worse credit score. Now they may have been clients that are affected by the COVID and the lockdown, everything going on. So they may be holding off paying their debtors. So they may be 2 that you want to look at. You've got the outstanding balances, you've got recommended credit limits that come with the company credit report. So you can see what the outstanding balance is compared to that. And then fundamentally, you can actually see removing any human touch or human element, understand how long it takes your clients to actually pay you. So most of mine are 50, 60 days, but I can actually see how long it takes as an industry sector that my clients are in, how long it takes them to pay their debtors. So I've got 67 days compared to 18 and 64 down to 25. That's telling me that if I go and speak to other businesses in that sector, they're going to pay me quicker. And I have I have lots of bad paying clients in the industries. Now, when I go through further into the information on the analysis screen, you can look at sectors and understand if you've got a niche market. So understanding sector, how many clients, and the open and late invoice value. But this might also highlight problem sectors to you that you didn't know you had. You may have real estate, for example. I've got 12 clients in there. It's my highest amount of open invoices, but I've also got the highest amount of late invoices. Now you can take a business decision on that to say, well, actually, let's work with these ones. Let's not take any more new clients from that sector because they're causing me more of a headache than anything else. And then lastly, what we're able to show you as well, and everything at a glance, you want to be able to get information quickly, is the highest risk active customers. Now, this will normally be a list between 5 and 15 clients. It will show the clients with the worst credit risk, and it will always stay as these 15. Obviously, if you get someone with a worse credit score come on, they'll take someone's place. But the idea is it will show you what their overdue balance is, what's been paid in the last 30 days, when the last payment was, and when the last correspondence was with that client. Simply helping you keep on top of your riskiest debt as well. Now, that's kind of a whiz-stop tour of the analysis screen. Hopefully that's been useful to yourself, Lee.
Yeah, fantastic. I mean, look, I love all these statistics and data. It really does help clients really analyze that debtor's ledger rather than just looking at the number and how much he's owing. I am very conscious that there are other elements to Satago, and I'm sure you'll be appearing on future tech talks to go through the credit control facility. And there's a little bit of financing in there as well. So I'm sure we'll be inviting you back there. But in terms of this particular tech talk, that's been very useful. It just leaves me to say thank you very much for your time, Ashley. And hopefully we'll see you soon.
No problem, Lee. It'll be a pleasure to come back.
Speak soon.
Cheers. Bye now.
Thanks, Lee. Fantastic product. Really like those alerts around high-risk industries and customers that you've got in your debtor book that need special attention because their credit rating is so poor. Okay, we're going to go on to back to basics now, and I'm going to pick up on the cash flow that I did part 1 of last time. You remember last time we talked about how transactions behave differently because they could be revenue, it could be capital, and they have different timings. And that's in essence why you have a difference between the profit at the bottom of your P&L account and the movement in the bank. This time, we're going to show you how to calculate that yourselves.
Hello, everybody, and welcome to Back to Basics, the cash flow part 2. You remember from part 1 how I described that the profit at the bottom of the P&L account rarely, if ever, agrees to the movement in the bank account. And that's for 2 principal reasons. Firstly, the timing of transactions, and secondly, the nature of transactions, i.e. are they revenue or capital? Let's remind ourselves of our little baked bean company profit and loss account. And from now on, I'd like to change the title of the net profit before tax to operating profit. I will be doing an extended version of the profit and loss account in future episodes. And you'll see there are different descriptions of the profit in there. One is the operating profit. And in preparing a cash flow statement, it's the operating profit that we go down to. In my example of the baked bean company, actually that net profit before tax is the operating profit. Now let's remind ourselves of the balance sheet that we had for Baked Bean Co. And I've popped in there again the movement on the bank account of £520,000, the profit and loss account movement of £750,000, and therefore this missing £230,000. Where is it? That's the whole purpose of preparing a cash flow statement. Now, you'll also remember from an earlier episode on the balance sheet how I described that all assets and liabilities, when added together, equal nil. All debits equal credits. That's why it's called the balance sheet. However, we don't present assets and liabilities in that long, meaningless row. We actually present them in a way that allows the reader to understand the performance of the business. We present them according to how they behave. By example, if we take the current assets here and compare them to the current liabilities, we get the net current assets, and that tells us about the liquidity of the company and allows us to produce some key performance indicator results, such as the current ratio or the quick ratio. Stage one, however, in preparing a cash flow statement is indeed to put the assets and liabilities in one long row. And I've done that here. Now, as you can see, they all add up to, both sides add up to zero, the current and the prior year. What I'm going to do now is to introduce a movement column. And I've put in there once again the movement on the bank account and the profit and loss account to show our missing £230,000. Now, arithmetically, you can see that the current year balance sheet equals nil at the bottom, as does the prior. Therefore, if we were to populate the remaining rows in the movement column, i.e. our missing £230,000, that will also equal zero. Let's do that now. So we're now into the second stage of preparing a cash flow statement. We need to allocate the movement column into those items that relate to operating profit and those that relate to the balance sheet. Here's the template that we carry out those calculations on. I'm just going to move myself across there. Okay, and the first thing that I'd like us to do, the first row that I want us to allocate actually is the profit and loss account. By reminder, here is our operating profit. £1 million, corporation tax of £250,000, and the bottom line movement of £750,000. So million, 250 and 750. Let's allocate that now. Here's our profit and loss account movement of £750,000. I'm going to put the £1 million straight into the operating profit column, and the 250 goes into the corporation tax column. Let's go back up to the top now and allocate the rest of those columns. First of all, fixed assets. Fixed assets move for two reasons, principally two reasons. One is because you're buying new fixed assets or you're disposing of them. And two is that you've got depreciation on those assets. In the background, I've got a fixed asset register for this baked bean company. You'll remember from Cashflow Part 1 how we bought a canning machine for £100,000. So we allocate, first of all, that capital transaction into the capital expenditure column there of £100,000. Put our £50,000 depreciation as a timing issue into the operating profit column. And we do the same with the remainder of fixtures and fittings and computer equipment. Now let's deal with the current assets and the current liability movements. We've got timing issues and they relate to the operating profit. This is when we pay for items compared to when they appear in the profit and loss account. So here we've got an increase in stock of £30,000 and we've got a decrease in debtors of £40,000. They're timing issues that relate to the operating profit column. We've also got £25,000 increase in trade creditors, a timing issue. Again, it's in the operating profit column. Corporation tax is allocated onto the balance sheet because remember, we only go down to operating profit level. Everything below that is considered to be a balance sheet item for analysis. And therefore it goes its own column there of £70,000. Other items we've got to allocate, we've got a movement of £300,000 on our long-term loans. We've got repayments and therefore going to their own column there. It's a capital transaction. So we've now got effectively our cash flow statement prepared, but it's not in the most meaningful format. So we present it in a report format. And all we're effectively doing is taking these totals at the bottom. We could understand the cash flow from here by saying, well, where did the money go? Well, we had 1.1 million in cash-based operating profit. We paid corporation tax of 180,000. We repaid loans of 300,000 and we spent 100,000 pounds on capital expenditure. But let's put it in the report format that we're all used to. So let's summarize our cash flow statement. We had a £1 million operating profit, but we had a movement in the bank of £520,000. What happened? First of all, we had non-cash items in the form of depreciation, £65,000. We had movements in our working capital of £35,000. Therefore, ignoring the timing of transactions and non-cash items in the profit and loss account, we would have had a profit of 1.1 million if the profit and loss account reflected the transactions that were in the bank. So what happened on the balance sheet in terms of capital transactions? We spent £100,000 on our new canning machine. We had loan repayments of £300,000, and we paid last year's corporation tax bill of £180,000. So total transactions capital transactions on the balance sheet of £580,000. That gives us our movement in cash of £520,000. So to reconcile that, if we add on to our movement the opening balance on the bank account of £115,000, we must therefore have a closing cash balance of £635,000. And indeed, if you check the balance sheet, you'll see that reconciles to £635,000. See you in the next episode of Back to Basics.
Okay, so if any of you guys would like a template of the spreadsheet that I used to calculate the cash flow statement, just email me, I'll gladly send you a copy. Okay, now it's time for tax tips with Mark Overend.
Right, okay, for this month's tax tips, we are going to look at the tax treatment of the various government support grants being issued over the last 18 months as part of the support packages made available to businesses who've been forced to close or have had their trade significantly impacted by COVID. All of the tax treatment for these grants is going to follow the accounting treatment. And so for this month only, Lee has joined me in tax tips to help navigate us through the various treatment of these things. So hi, Lee.
Hi, Mark. Enjoying my little tax tip cameo here?
Yeah, make the most of it. You won't be coming again. So yeah, like I say, the tax treatment is going to follow the accounting treatment. We've got various grants to cover. There's the self-employed income support grant. There's the CGRS grants, where any business furloughing staff has received at least 80% of the wages for the vast majority of the time they've been furloughed. And we've also got what I suppose we'll loosely call the business rate support grants that have basically been paid out via the business rates system by the local councils. Just for clarity, obviously C-bills and B-bills, the bounce back loans, the C-bills loans, they are loans and not grants, and therefore not taxable at all. So we are just going to focus on SEIS, CGRS, and business rates loans. So Lee, over to you. The accounting treatment is the bit that needs to come first. So if you could guide us through that, then that'll give us the tax treatment that we need.
Sure. So I mean, for all entities, the CGRS claims and the business relief claims are going to fall under the grants accounting treatment. And this isn't new legislation. This has always been within the FRS 102, section 24, for those that want to read up on it. And fundamentally, that breaks down grants into two categories. Those that are measured on the performance basis and those that are measured on the accruals basis. The difference between them is basically the performance basis. There is a preset range of criteria that you must meet before you can recognise the grant income. And the accrued one, you just basically release the grant or recognise the grant when the income or expenditure to which it relates is incurred. So for these grants from HMRC, they all effectively, now there is some chatter about whether this is right or wrong, but effectively the majority of the accounting professional bodies agree that these meet the performance criteria, and therefore we need to recognise the grant in the accounts at the time they became eligible. And that's the bit that's important, because it's not really when you've received the money, it's when the money was effectively available to you. The best example of this is the furlough claim. So the March furlough claim was triggered in March. That's your staff payroll costs. You incurred them in March. The furlough grant that you received was relating to that period, and therefore we need to recognise the income in March, albeit you've probably received it in April. A little bit of a timing difference there then in terms of the grants received from an accounting point of view. You effectively are going to pay tax a little bit earlier, but the timings from HMRC have usually been quite good in terms of when you've received the money compared to when you were technically due the money.
Okay, thanks, Lee. So from a company point of view, we're going to be having some adjustments in accounts, aren't we, really, with showing CGRS grants especially common. They're going to be effectively wherever somebody's year end cuts off, you've used March there, we're going to be putting money received in April back into March, aren't we, basically?
We're going to have an accrued income line in these accounts, just to recognise that income that you've not yet received, I'm afraid.
Right, fine, thanks for that. So to move on to the SEIS grant and effectively contradict everything that Lee's just said, the SEIS grant is taxable when it's received. Now, for the first SEIS grant, I imagine you receive that in June or July. And so most self-employed individuals, sole traders, often run their accounts up to the end of the tax year, or 31st of March, which is very close to the end of the tax year, which is 5th of April. And so you won't really have much of a problem in accounting for income received and aligning it with a tax year. One of the complexities we'll have is for a business, whether it's a sole trader or a partnership, that doesn't run its accounts to the anywhere near the end of the tax year. So as an example, for the first SEIS grant, if you declare your accounts normally up to the 31st of May, you might do a set of accounts the 31st of May 2021 and receive your SEIS grant in June 2021, and therefore expect to account for that income in the next accounting year, which is 31st of May 2022. Now, the consequence of that would be that you wouldn't tax that income receipt until the tax year ended 5th of April 23, and therefore pay the tax on it on the 31st of January after that date. The government have said that actually you can't do that. And even though your accounting year runs at 31st of May and you receive the income in June, you must ensure that if you received an SEIS grant in an income tax year, so in my example here, we've received it in June 21, therefore the income is the relevant income tax year is the tax year to 5th of April 2022, we must account for it in that year. Now, obviously, it won't form part of your accounts because the accounts will have been drawn up to 31st of May. And so the government have recognised that and added an extra box on the self-assessment tax return to allow us to declare this self-employed grant separately to anything else that would normally go through your accounts. It is a point to watch out there for, especially as we go further into the year. All of the SEIS grants that people have received throughout this year to 5th of April 2021 will all fall for taxable in that year, and therefore will have to pay the tax by 31st of January 2022. We therefore need, as part of the self-assessment process, if you haven't already sent us your tax return information, we will need to know which grants, if any, you've applied for and successfully received, and the amount that you've received, so we can ensure it's included in your tax return this year.
Okay, so this month's tax tip is about mileage payments for employees undertaking business journeys in their own cars. If an employee is making a business journey in a car that is petrol or diesel, then you can pay them 45 pence a mile for the first 10,000 miles they do in any given tax year. For anything above 10,000 miles, you can pay 25 pence per mile. For any business journeys an employee undertakes with another employee as a passenger of the car, they can claim an extra 5 pence per mile on top of the 45 or 25 pence they're already claiming. If an employee is driving a company car, then you can't pay the 45 pence rates, but you can pay the advisory mileage rates, which relate to just the fuel element. And those rates are available online and vary from quarter to quarter and based on the car's engine capacity. The final part of this tip is about fully electric cars provided as a company car. We've been asked a number of times if
employees who are driving a company car that's fully electric on business can be reimbursed for the electricity they're using if they've charged that vehicle at home? The answer is yes, and you can pay them 4 pence per mile.
Thanks, Mark. Lee, stay out of Mark's tax tips. He doesn't like it. 2 takeaways for me there. I think that if you're looking for consistency of income as a self-employed individual and you're looking for finance, then the timing of your grants will affect what income you've got in your tax returns. And if you're a company, make sure you get that year-end cut-off correct. If you're not a client of Ascentis, should I say. Better to have them get that right now than have the inland revenue unravel it for you at a later date with the usual interest and fines that could incur. Right, it's time for Lee and his admin min.
Hi everyone, all the usual deadlines are here for you on the screen. The ones that are most prominent are going to be the P11D deadline. That's going to be quickly approaching on the 6th of July. Same applies for anyone with a pay-as-you-earn settlement agreement with HMRC. Also, don't forget the CJRS deadline of the 14th of every month. And from the 1st of July, we've got the new furlough scheme kicking in. So the 80% contribution that you have to make to your employee, HMRC are only going to contribute 70% of that, leaving you with a 10% shortfall to pay for yourself. With VAT, we've got some new EU regulations coming in terms of e-commerce VAT. Predominantly going to affect those customers that are business to customer operating in the EU. For personal tax, we've got the 5th instalment of the Self-Employed Income Support Scheme grant. That's likely to land mid-July. And don't forget, we've got the payments on account due on the 31st of July.
That's it, guys. Whoever said accountancy was boring? Time flies when you're having fun. It's the end of the show. Thanks for joining us. And if you enjoyed it, hit the bell, subscribe, all that kind of stuff. And we'll see you in July. Until then, take care. Bye-bye.